Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on Twitter, like we normally do in the mornings. See what they're sharing on social media. It's going to be related generally to three topics: wealth building, financial topics, and/or commodities. So let's dive in there. Let's see what people are talking about, and I can share my opinions as we go through it. If you want to follow me, it's at Finance, and if you want to join our community, it's finding-value.com. We just had a question and answer session where I did a bunch of training in the beginning, and that is posted on the website. We do have a discount called LEAP, 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 if you're interested. So Rev says, coming to a housing market near you, affordability is going to be completely idiotic until we add more supply or let the stocks go down. LOL on that happening. So rent versus buy, San Francisco, the house was listed for rent for $5,400 a month. Later, presumably did not rent. Listed for sale then at about 1.6 million. Sold yesterday for 2.0 million, and that would equate to a mortgage on that house that would be $14,000 a month. Now, again, it depends on how much people put down on the property because your mortgage is dependent upon how much you take out. But yeah, that does seem a little bit weird. And the value is a little bit disconnected between the rent and the potential payment that you would have to pay to purchase it. Now, if we exit winter with full storage in Canada, will summer AECO go to zero? Asking for a friend. You can see 2024 that we haven't had the drawdown in natural gas like we have towards the 5-year average. Could that be a problem in the short term? It very well could be. Or are those LNG terminals that are being built with takeaway capacity going to suck down this inventory? That's really the question. Is it going to do that? But right now, we are sitting at very high inventory levels for AECO. No real growth, just currency devaluation when you price stocks in gold. And you can see the big waves that occurred. It was pretty stable from 1884 all the way till about early 1920s. That is when the Federal Reserve went into power, 1913. And then this is what's occurred, the boom and bust cycle getting larger and larger as time progresses. Could we put a line through here where we go somewhere up here? I mean, I guess it's possible, but I think with where we're at today, I think this is going to actually go lower at some point where we head lower and gold outperforms given the market conditions. That's my take. But that doesn't mean that's going to occur immediately. This is from Warren Buffett. What the wise do in the beginning, fools do in the end. He's talking about buying stock, most likely. The wise buy it in the beginning, the fools buy it at the end. And that's the end of the cycle. Another Warren Buffett one. You have to love something to do well at it. It's an enormous advantage if you absolutely love every minute of it. And then Walter says, stay with what you like to do rather than do something you don't like, but think you can make money out of it. That's their opinions there. And I would agree. I would rather do something that I like and potentially make a lot more money because I want to dump more of my effort into it than just clock in and out thinking that I can make money and basically sacrifice your life a little bit for making some money. Coming on down, Lance Lambert, 11 studies, one conclusion. So 11 studies, one conclusion. The U.S. housing market is underbuilt. It's Mala Smagan's first deep dive for Residential Club is a must read. The housing market is underbuilt. So if you want to read that, go ahead and click it and dive into that. Jeff Bezos never focused on earnings, earnings per share, or profit. Why? He knows those numbers are flawed. Here are three key reasons why he focused exclusively on free cash flow. Our ultimate financial measure, and the one we most want to drive over the long term, is free cash flow per share, because you cannot manipulate it. You can manipulate through financial engineering, we'll call it earnings, earnings per share, or profit. It's a lot more difficult to mess with free cash flow from operations. Very hard. Is the Fed pivot going to lead to a decline? Previously, that has often been the case, though on a lot. It depends a lot on how the economy is doing. During expansions, a Fed pivot can be constructive for stocks, but if the economy is slowing into a recession, the opposite is true. A lot of these are from housing market bust cycles. We had a housing bust here, a housing bust here, we had a housing bust here, and a housing, no, that was COVID. But a lot of these are housing busts. The ones that aren't is this 2000 crash, the tech bubble, and these other ones are all housing market crashes outside of these two. So if they lower rates, are we going to get crash? I don't know, and it's not going to be from the housing market. So this one is out, this one's out, this one's out, and this one is out. So we have these two instances. So we get a COVID crash potentially, or a tech bubble, which is possible. I mean, it's possible. And those are the two that I think would probably be the top picks, so to speak, for potential causes if we do get a slowdown. Warren Buffett again, it says, look for the job that you would want to hold if you didn't need a job. So look for something that you want to be in, irrespective of needing it or not. And I completely agree with that. Like I would go work somewhere even today if I really wanted to do it. But if it's something that I'm doing just for money, it's like, I don't want to go back into that where you have to deal with a bunch of garbage, bureaucracy, red tape, and even like all the systems that you have to learn that's just non-value added everywhere. Dealing with HR, blah blah blah. It's pretty rough. it's um, so still having a massive short position, weighing on silver, a lot of room to go, but hopefully the start of something bigger. I mean, look at it. Silver has the highest potential for an erratic move, period. So these are the two largest short positions, silver and platinum. Then we've got gold. And then cocoa's been ripping it to the upside. I don't know if you guys have been seeing that. That thing's just on fire. But four largest traders, eight largest traders, they're all short silver and platinum. Those are the two metals. And those are the two metals I'm overweight. At this stage, valuations at the peak aren't anywhere near as bubbly as during the dot-com bubble or dot-com boom. Back in March of 2000, the top five stocks were trading at a whopping 43 times forward PE, a staggering 59% higher than today, Mag 7 at a 27x multiple. And I know back in the 2000s, they were doing all sorts of financial accounting. Like they were discounting future ideas to today and putting it on the books. Pretty interesting stuff they were doing in the dot-com bubble. But that is interesting to know that the valuations are lower today than they were in the dot-com bubble of the top five stocks. The risk in the second half now moves to a capacity crunch over capacity weakness. So the US freight recession is transitioning into a freight bull market, and it's bullish oil. So one of the most important technical indicators in the trucking market has been triggered. The spread between contract and spot has narrowed to the pre-COVID range. Before COVID, the delta between contract and spot trucking rates was minus 0.35 to zero point 0.5 miles, meaning that it was 35 cents to 50 cents a mile cheaper to book a truckload from the spot versus contract market. Once COVID started, the market flipped and it became more expensive to book freight on the spot market. When the freight recession and collapse hit, The spread reversed to the downside and stayed at much wider ranges, suggesting that the market was nowhere in normal balance. This has corrected over the past 6 weeks as spot and contract are closer to converging. This suggests we are in the last leg of the current freight recession. The risk is the second half now moves to a capacity crunch over capacity weakness. And this is what makes me think that we just went through the slowdown. Like the recession or the slowdown is occurring and we're coming out of that slowdown. It's just masked from fiscal spending and it's masked from a nominal perspective. So this is the real slowdown here that we're charting, and this is coming out of that slowdown, perhaps. That's my opinion there. Coming on back, we've got emerging market stocks see a weekly inflow of 20.8 billion, the most in history. Look at the move into emerging market equities here. Huge flows of money, record inflows, and I think the market is getting ready for a potential weaker dollar, and money is starting to flow in these emerging market areas. We can see that in some of the stocks that we hold on the website too, where we're in these emerging markets and they're starting to break horizontal resistance levels to the upside. So it's looking good. Charlie says, try more to profit from always remembering the obvious than from grasping from the esoteric. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. So more profit in remembering the obvious than grasping for the esoteric and doing that in the long term. So that's the advantage. Just don't do anything overly stupid. Fabi says, I'm not laughing, you're laughing. It's easy for Ukraine. They're never experienced a Chernobyl-like nuclear catastrophe like Germany. It says exclusive. Ukraine to start building 4 new nuclear reactors this year. All right. And the winner is crude oil production percent of the world total. United States ripping it, Saudi Arabia down, and Russia down. And that's who's making up the difference. Now, when I look at this, it's like, well, if we peak in the United States this year or next, it's going to be a very interesting mix for worldwide oil production. And I think that could be the case 2024, 2025, where shale oil rolls over or at least flatlines going sideways for a while. And we'll see what the rest of the world could do. This is Cisco versus NVIDIA, 2000 versus 2004. And you can see NVIDIA is ripping it. And this is Cisco on the left. And he's got the same type of setup here where you get a big move to the upside. And again, that's a fractal. We're comparing 2 fractals, repeated moves over time. And maybe that's what it looks like. Maybe we have a little bit more of a melt up before heading lower for NVIDIA. Now your risk reward is this is the upside risk or reward. And then the downside risk could be a pretty big move to the downside here. So it's pretty much it's not an asymmetrical bet. It's a symmetrical bet. Equal upside, equal downside, which could be a possibility. We don't know if that's the full extent that it goes to the upside. Peter Lynch says, a drop in a good stock is only a tragedy if you sell at that price and never buy more. To me, a price drop is an opportunity to load up on bargains, says Peter Lynch. And some of these, I would say that's true. We probably have to wait a little bit because natural gas is still falling, but I think natural gas is getting pretty cheap. And I think there's going to be some opportunities there whenever this thing bottoms out. Grady says the very big picture ratio chart shows how undervalued silver really is versus the stock market technology sector. When this chart starts to rise, the global capital flows into precious metals from the stock market, USD and bonds, etc. should start for real. And this will be the bottom here. It's a double bottom. This is the silver versus the NASDAQ 43-year chart. And he says, a reverse symmetry move is quite likely as general equities moves into secular bear market and precious metals breaks out into a continued secular bull market. This is everything except commodities bubble, where commodities and precious metals outperform. You can also see on the relative strength indicator the divergence of the strength increasing even though the price is slightly going lower. Like the ratio is slightly going lower. Coming on down, time moves on, charts morphs, don't fight it. Gold versus the CPI. 2001 breakout, kind of another consolidation, breakout, consolidation, and we've broken out of that consolidation to the upside. We've got a little bit of resistance here he's got, and he's saying, watch for the breakout here. We're getting close. And when gold outperforms the CPI, I think that's generally when uh, the mining companies start to outperform as well because gold's going up at a faster pace than inflation. Let's read this one from Gary Savage. Human emotions are funny things. At bottoms, I can't get anyone to buy. At tops, I can't get anyone to sell. Back in October, we had about a clear of a bottoming signal as we ever get, a bloodbath phase. Those are exhaustion patterns. You can check the comments on my tweets at the time. Trolls were rampant telling me I was an idiot and that the gold could never go up. I couldn't get traders to buy. I advised traders take profits on December 29th. I knew the cartel would fight tooth and nail to prevent gold from closing the year at new highs. This time, I couldn't get traders to sell. Recency bias is a powerful incentive to expect whatever has been happening to continue happening. If price has been dropping for many weeks when traders assume it can only continue to drop, if it's been going up for many weeks, that of course means it will only continue to go up, and if you sell, you will miss the gains. Recency bias, it has become exceptionally intense lately because metals and miners have done nothing since the top in 2020. Everyone is now convinced they will never do anything. It actually means the exact opposite. This mind-numbing sideways churn is building the fuel for a breakout and rally of legendary proportions. Remember the rule, the bigger the base, the higher in space. We knew the cartel would throw everything at the metals sector during this intermediate cycle, so it would always go to be 50-50 whether gold would be able to defeat the suppression and break out. With that major attack in the middle of the night on December 4th, we got the answer to that question. We were going to have to wait until the next intermediate cycle. That intermediate cycle is approaching. Traders are sliding back into the same mentality they had at the October bottom. They again can't see any way metals can rally. They are going to rally though. Gold is going to break out above 2100 during the next intermediate cycle. Silver is finally going to retest the $28-30 zone. It came up $1.50 short during the last cycle, and maybe even get to $40 an ounce. The vast majority will miss the move, though, because they've become convinced that metals are dead money. They won't be able to buy when I give the signal. When they finally do buy, they will sell way too early because they've been conditioned to only expect disappointment from metals. Finally, they will cycle back to euphoria and again fail to sell when we get the next intermediate top of $2,300 to $2,500. For those of you capable of suppressing your recency bias, probably not many of you, I know, you're able to get an incredible buying opportunity. I'm monitoring the metals as they continue this correction and watching for the signs that a bottom has formed. When I see those signs, I will let subscribers know it's time to pull the trigger. So that's his opinion of where we're at in the gold and silver markets. The horrible sentiment going on right now that thinks it's dead money, which I agree, is providing that bottom. The sentiment being this negative is where it feels like we're getting closer and closer to a bottom. And that's his opinion. And that's what I've got for today, guys. So I'm going to end it there. Give me a thumb up for the content, subscribe to the channel, and yeah, that's all I've got for today. So we'll catch you next time. This is Finding Value.